My strategy for building a dividend portfolio. Everyone would love to have a monster dividend portfolio, one that spits out huge dividends day after day, thousands and thousands of dollars. A portfolio of businesses that produces so much income every single month that you can live off of it. It completely subsidizes and replaces your active income. Dividends, after all, are passive income. It's money that you make without having to lift a finger. Now you have to do the initial upfront work. You have to buy the investment. But once you've done that, you're set. This is not only what my entire portfolio is centered around, but it's also my ultimate goal, to get to the point where I'm no longer reliant on active work. Where working is an opportunity, a choice, not a requirement. I've been building this portfolio publicly for some time. I do it under public scrutiny. You can see the changes I make, the buys I do, and the sells I make. But in this episode, I'd like to do something a bit different. Instead of just showing you my most recent trades, I'd rather show you the lessons I've learned building a monster dividend portfolio over the past 5 years. I want to go over what I think are the biggest mistakes dividend investors are making, what they should be focusing on, and how I believe you can get to your goals as fast as possible. Building a monster dividend portfolio. First off, building a monster dividend portfolio. This is something I've been working on for 5 years now. When we're building this, there are 3 basic ways that it compounds. Number 1, have a consistent active income. You can't leap over to passive income without an active income. You need a stable job and you need to have your budgeting down so you have money every single week to add to your portfolio. Once you have that money, you need to put it to work as soon and as frequently as you can. Number 2, reinvest the dividends. Once a company pays you that cash flow, use it to buy other companies that you consider high return opportunities. My way of doing this is a tool I built called the Dip Finder. It shows which of my core holdings are in a dip. I can see right here that Canadian Pacific, MasterCard, and Vici properties are in the red over the past 30 days. S&P Global, on the other hand, has gone on a pretty good run. So I'll avoid the companies that are up a lot, and I'll buy the companies that I think are really good that have gone down. And guess what? Just a couple of days ago, I bought more Vici. Number 3, the company grows the dividend over time. This changes our criteria. We don't just want companies that pay a dividend, we want companies that pay a growing dividend, growing beyond the rate of inflation. We can take Verizon as a counterexample. This company does pay a dividend, and it is technically growing by 2.39%, but inflation has been above that. The dividend payment, adjusted for inflation, is the exact same today as it was a decade ago. On the other hand, every single company in my portfolio, S&P Global, MasterCard, Apple, Microsoft, Vici Texas Roadhouse, they all pay consistent and growing dividends. These 3 steps together are really powerful. The compounding effect is almost magical. Where dividend investors are failing. Now that seems simple enough. But I notice a lot of dividend investors make some very critical errors. And a lot of these criticisms are basically me criticizing myself 5 years ago. Mistake number 1, focusing on starting yield. The starting yield is what the company's yield is right now, today. A lot of investors seek companies that will instantly give them a high starting yield. We can look at Verizon again. It lures investors in with a very high starting yield of 7.31%. You may look at this and think, wow, I buy $100 of this and I get $7.31 back every year. That's pretty good. The temptation to buy these hefty starting yields without looking at the fundamentals leads to lots of underperformance. Verizon has been a horrible company to own, going down 28% over the past 5 years. Why? Well, Verizon hasn't really grown revenue. They've been diluting shareholders, and they have a breathtaking amount of debt, over $100 billion. This giant telecom company is really nothing more than a value trap. AT&T is another one. I used to be in this. What lured me in? The nearly 7% starting yield. But AT&T is down 41% over the past decade, and they recently just slashed their dividend in half. So, the number one mistake: don't focus on the starting yield. Ironically, I get criticized for focusing on companies with low starting yields. I bought S&P Global, which has a 0.95% yield. I bought MasterCard with a 0.61% yield. These companies aren't value traps. They have the economic capability to grow their dividends at very rapid rates. Take Texas Roadhouse. Its starting yield is only around 2%. But the dividend is growing at a very fast rate. Back in 2011, the dividend was 8 cents per share. Today, it's 55 cents per share. That's a compound annual growth rate of 16.4%. This means investors who bought 10 years ago now have a yield on cost of over 8%, higher than Verizon, and they've had massive capital appreciation of 347%. The evidence favors companies that focus on dividend growth, not high starting yields. This reminds me of the delayed gratification experiments with children. The kids willing to wait a little bit longer had overall better returns. As investors, we get tested in the same way. Can you delay that gratification a little bit? Invest in great companies that will 5x your dividend payment over the next 10 years. Mistake number 2 and number 3. The next big mistake I see is over-diversification. Now, diversification is not bad. It helps lower your specific risk, the risk of one company's management failing. But the data shows that once you have over 7 to 10 different companies, that specific risk is basically gone. Layering on more and more companies, 30, 40, 50 companies, gives you no more benefit. All you're doing is cluttering your portfolio with companies you can't possibly pay attention to. In my portfolio, I have 10 core positions. I can keep track of 10 companies. And finally, the last mistake: investing in bad industries. This can come off as harsh, but I think a lot of dividend investors buy into companies that are capital intensive, overly complex, and in difficult industries. I used to own stock in Boeing. It was one of my first investments. But I quickly learned that Boeing is an incredibly complex company. Huge manufacturing processes, tons of liability, potential lawsuits. Running it would be like trying to run a small country. I see the same thing with Intel. Intel was king not too long ago, and now look how far they've fallen. Or 3M, another high-yield company that's been a value trap for a long time. The companies I've been gravitating to are simpler, with better economics. S&P Global, which shares a monopoly with Moody's. Microsoft, with its massive monopolistic moat. Even Costco. It's much easier to open a new warehouse than it is to create the next big aircraft. My final piece of advice: focus on industries where everybody's winning. Where you're fishing in a good pond, not trying to pick winners amongst losers. Thanks for watching. Please like if you found this helpful, leave a comment, be sure to subscribe, and share this video. You can find useful links in the video or channel description. See you soon.